Welcome to episode 11 of the Cashflow Connections podcast. The episode for today is Preparing for the Future. In this episode, we discuss some of the trends, technologies, and economic shifts that are set to take place over the next 5 to 10 years and how you should be positioning and structuring your investments to be well protected. The truth is, there are a lot of really important questions that you need to be asking yourself when looking at the upcoming changes that are taking place. So, for example, what are the effects of self-driving cars? How is this going to affect your real estate portfolio, especially if you have a lot of parking lots? What effect are robots and automations going to have on your investment portfolio? We're going to talk about all of this today with a very knowledgeable guest. In fact, it is our first ever repeat guest on the show, so I'm really looking forward to it. Also, I wanted to mention, it has been a really exciting few weeks here at Cashflow Connections. I was recently asked to be a guest on the Tom Woods Show, which is a very large and influential libertarian and economics podcast that I've been listening to for quite some years. The show gets thousands of downloads each episode, so when our episode launched, it briefly pushed Cashflow Connections to the top 100 business podcasts on iTunes. So just want to thank everyone and welcome all the new listeners. Also, just a quick reminder, one of the major metrics people look at when they decide to be a guest on the show is how many reviews the podcast has. So if you will do us a big favor and leave us a review on the podcast app, it would be greatly appreciated. So much so that I will give you a free copy of our new ebook on self-storage investing. Just leave a review, screenshot it, and then send the screenshot to info@cashflowconnections.com, and we will send you a download link immediately. All right, let's get straight to the episode. How's it going, everyone? Today, our guest is Jeremy Roll, who's been an active real estate investor for over 14 years, who left the corporate world in 2007 to become a full-time passive investor in cash flow. He is currently an investor in more than 70 opportunities across over $500 million worth of real estate and business assets. As president of Roll Investment Group, Jeremy manages over 1,000 investors in the US and Canada who seek passive investments in real estate and businesses. Jeremy co-founded FIBI in 2007 with the goal of networking with, learning from, and helping other investors. And now this group has grown to be one of the largest public investor meetings in California with more than 12 monthly chapters and over 23,000 members. Jeremy also has an MBA from the Wharton School. So Jeremy, thanks a lot for coming on once again.
Hunter, thanks very much for having me. I really appreciate it.
I got to let you know, the first episode we did together, which was conducting due diligence on commercial real estate, has had a tremendous amount of positive feedback. For all listeners, if you haven't listened to that one yet, make sure to check it out. I'm really excited for this one, and I'm sure the listeners are too. So usually we go through and kind of talk more about your perspective on investing from a big picture, but since we've already had you on the program, we have a good idea in terms of what you really look for. Let's just jump straight into the topic at hand, which is trends, economic trends, specifically trends that are going to be interesting for investors over the next 5 or 10 years. So what are some of the major trends that you think that are coming up that real estate investors should be paying attention to in that time horizon?
Yeah, that's a great question. So the first and most obvious one, I think, is that everyone out there listening probably needs to understand, and I'm sure most of you do, that real estate is cyclical. So we've had a pretty good run up since 2009. That's an understatement, relative to historical as far as percentage increase. And so we are due at some point for a correction. Now, whether that means a minor correction, a major correction, or an outright crash is really anyone's best guess. What I would say is that historically, when we've come out of a recession that was due to having too much debt associated with it, typically the next downturn isn't as bad as the previous one, but the one after it is bad again. So I'm expecting, based on historicals, that we have some type of correction, probably not as bad as 2007, but nobody knows for sure. That's the number one thing I would say that is almost a certainty to come up in the next 5 to 10 years. So that's definitely like important point number one and focus number one. From there, I would say that the higher level, kind of longer term economic trends that are coming up that could be very important depending on which asset class you're looking at include a number of things. Number one is that the inflation-adjusted median household income continues to languish in the U.S. Economic growth continues to be pretty low in the U.S. It's definitely we're having structural issues with it. So number one is you probably want to consider the fact that I don't see a good reason to expect high economic growth or high household income growth going forward. If anything, I would expect it to be somewhat flat or very low growth. And so you definitely want to consider that depending on what you're investing in. There's also some other trends such as there's potential for robots or automation to have a very large impact on a lot of jobs across a lot of sectors. And that can have a lot of different effects on real estate, including demand for certain types of real estate, household incomes potentially dropping as a result, and therefore like lower income services and products being in demand versus higher income. There's a lot of different things that can go into that, and we can get into the details. And then finally, there's the advent of self-driving cars that potentially could completely change the demand for certain types of real estate. And if robots and self-driving cars sound like crazy talk to anyone who's listening, and I can understand why, really, I think you're going to be surprised how quickly some change can happen. So let me give you a great example. The iPhone first came out in 2007. That's 10 years ago, only 10 years ago. That means that more than 10 years ago, we did not have these crazy supercomputers in our pockets. Think about what's happened since we've had these supercomputers in our pockets and what we can do with them now versus just 10 years ago. That's not a long time ago. I can tell you that publicly, a lot of large auto manufacturers had stated that they have goals of releasing self-driving vehicles to not necessarily to consumers at first, but to services like Uber and Lyft for commercial use around 2021, give or take a year. So that's really not far away at all. I mean, that's within 5 years. So within 10 years, it's completely conceivable that can have a huge impact on some of the use of real estate. And when you think about parking spots and other things, so there's a lot of different things to think about when it comes to real estate and demand with self-driving cars. So that's another thing I'm definitely looking at as a key trend. And finally, one of them that's a little more obvious as well is the baby boomer generation retiring and aging. Even though that's already happening at about 10,000 people a day, certain asset classes will be impacted more and more as the population ages. So senior living is an asset class I'm really looking into with a lot of effort right now to better understand when those trends might impact that asset class the most. And then if you think about senior demand for either houses or not having houses or apartments or not having apartments and how that can impact certain real estate trends, that's also important to consider. So I know I just kind of put a lot of different topics on the table, but if I had to lay out my top thoughts for the next 10 years, those are definitely amongst them.
Very interesting. Yeah, you definitely touched on a lot there. So I'm very interested in the component about the self-driving cars. What are some of the investments or asset classes that you think have the potential to be really disrupted by that technology specifically?
Yeah, it's actually really hard to forecast. So there are some actually that are easier to forecast than others. So let's start off with drive-throughs. Okay, so properties that have fast food drive-throughs, for example. On one hand, you can argue that they're going to be in even more demand because self-driving cars could potentially be used by third-party services to go pick up those meals more easily and then deliver them to people more easily. But on the other hand, if you take a look at Jack in the Box, for example, it just has an app right now. I believe it's Jack in the Box, where you can actually order something from them on the app and then deliver it to your house in certain markets. Now, I'm not quite sure how they're facilitating that, but if they're actually facilitating it through their own kind of warehouse cooking facility, then all of a sudden those drive-throughs are no longer going to be of as much traffic. So that's one great example. Like, okay, well, how is it going to impact drive-throughs? And if you're looking to buy a retail center that has a drive-through, is that going to be a plus or a minus? Depends on who you ask and how this all unfolds. So a little complicated to sort that out. You have parking. So one of the concerns I read about self-driving cars is where does the car park itself and how many cars are going to be on the road versus now and all these other things. So there's a lot of things I'm still trying to even how can I put it, like sort through and really fully understand and try to extrapolate out what's going to happen. But I can tell you that my conclusion at the moment is that self-driving cars are going to reduce the amount of cars on the road. And I say that because right now, from what I've read, if you own a car, it's actually not being used on average 97% of the time, meaning you're only using it 3% of the time. That obviously includes overnight, but that's still around the number that the average is. Imagine if nobody owned a car and they just use self-driving cars to get around. What I've been told is that we probably need about 90% less cars than we need right now, because of the utilization rate of all the other cars, assuming they're using self-driving cars towards the 75 to 90% range. So if we have 90% less cars on the road, what happens to the large retail enclosed mall that literally more than half of its land is like dedicated towards parking? What's going to happen with that? What's the use going to be for that? And then what's going to happen with the office building that has a parking lot that can accommodate 1,000 cars when that's no longer needed? Whether it's even indoor parking and what can they do with those stories versus outdoor parking, right? Because there's both in office parks. So it's not so clear cut is what I'm trying to tell you, I think, Hunter, but there's a lot of thinking that has to go through. Like if you're looking at a specific type of property, you've got to really think about these things before you plunge into a 5 or 10 year commitment towards it, in that all these things could be changing quite rapidly. Another thing about self-driving cars is that if you look at the millennials, they have a much higher level of interest in living in urban areas, downtown areas and urban areas, versus the previous population that was really migrated towards the suburbs. And what's interesting is that it used to be that office parks would come up in suburbs to accommodate the surrounding living population because people would like to live near where they work. Well, now you've got these millennials who would prefer to live in downtown areas, and the advent of self-driving cars will actually make their commute a little easier to get to the suburbs. And so the question is, will those office parks potentially, what's going to happen to them, right? Because maybe less people will live in the suburbs, or less of the younger workforce will live near the suburbs. Are they going to take self-driving cars to those offices and they're going to deal with that commute? Or are they going to demand that they walk, for example, to their office space, and there'll be more office conversions in the urban areas? So that's something else to consider in just one asset class. So I don't mean to make this sound overly complicated, but I'm hoping for people who are listening to this, just make sure that you're taking into account these trends, because they can have huge effects on reshaping the demand for certain asset classes going forward.
Totally. Given some of those things you just laid out, specifically, millennials' spending habits, I think a lot of that demand for those inner city urban areas is, from my perspective, millennials aren't as concerned with purchasing a home. So a lot of the drive for the suburbs, the fact that you could actually buy a place if you moved 30 minutes plus out of the middle of a city. It seems to me to be that changed significantly after 2008, and millennials are not really concerned with owning anything, let alone a house. Do you think that that's in line with reality too, or do you think that's causing that as well?
Yeah, that's a great question. I do think that's a good point. And so there's another thing to think about, right? If you're looking at investing in houses or apartments, my logic tells me that even though millennials have had a very high demand for rentals at the moment, when it comes time, if you look at the population swath in terms of how old they are and the fact that they're delaying having kids, when they finally get around to having kids, what I anticipate is going to happen is that a lot of them are going to want to buy a house only to have the stability of being able to, knowing that they can stay in a house for 5 to 10 years, that stability that people look for when they buy a house. So I feel like part of the issue with the millennials so far has been that they haven't actually had to deal with that. And therefore, they've actually had the choice of either owning or not owning without having to worry about the stability as much, because they have more flexibility because they haven't had their kids quite yet. So I actually believe, just personal opinion, that there will be more housing demand in the next 5 to 10 years as the millennials get old enough to the point where they have their kids and they want more stability. But I don't read that very much. I'm just trying to think ahead on that, just a personal guess. And if that happens, then you wouldn't necessarily want to make as much of a bet on apartments in the next 10 years, but maybe more of a bet on homes. I'm just, as an example, I'm not saying I'm doing that, but just as an example on this topic.
Totally. What are some of the investments that you're currently really bearish on, given some of these perspectives?
Yeah, great question. So first of all, I think this probably won't surprise anybody who's listening, but I'm absolutely bearish and been bearish for many years on large enclosed retail malls. There's been a lot of carnage with actually a lot of bankruptcies this year, specifically associated with larger retailers, big box retailers. So definitely continue to be very, very skittish on that. Also skittish similarly in retail strip centers that have very large big box retailers. So when you think of a retail strip center, sometimes you'll find a strip center maybe has a lineup of 10 smaller retailers, mom and pop shops like mom and pop liquor store, mom and pop dry cleaners, et cetera. And there are some services that people are going to probably continue to demand, and they're not subject to the same type of future characteristics potentially as a larger big box, like having a Best Buy in a retail strip center, when you've got those larger big box retailers who are more likely to potentially downsize because they've got such high overhead with the retail footprint. So I'm a little bit careful, actually a lot careful on the big box retailers within the retail strip centers. And actually been in a couple retail strip centers that have been selling. Had sold last year. One's currently up for sale specifically because of that concern. And then another one I'm wouldn't say I'm bearish on, but I'm a little bit uncertain about is hotels. Hotels, generally I stay away from them because I look for stabilized, predictable cash flow, and the predictability of the cash flow of hotels is a little bit harder in most locations, not at all. The average daily rates can fluctuate a lot during economic cycles, so you can definitely be subject to the recession having a pretty large decline in revenues on average. But hotels, interestingly, if you look at them as a aggregate, they've actually languished since 2009 from a pricing power perspective. So they're the only asset classes that have gone about flat, relatively speaking, compared to like indexing, at 2009 pricing. So there's a little speculation as to why this happened, and it's not really clear to me. I don't really pay too much attention to the asset class, but I would definitely be a little weary about that asset class going forward to sort out why that's happening and what may happen in the future. Airbnb and some other things are obviously having some type of an impact depending on the market. And then what else am I bearish about? Industrial is real interesting to me. Part of me feels like industrial is going to have a lot of increased demand from e-commerce companies and online retailers, and all these apps and associated services with them. Part of me, though, is having a very hard time sorting out where the demand's going to be. So if you think about large industrial parks in more suburban or outlying areas, that's been, the kind of hub and spoke model a lot of large retailers have. I think of a Walmart with their distribution centers. That's been a strong place, a strong type of play for a long time if you're comfortable with the idea of having one or two tenants with, a lack of tenant diversification in a typical facility. But what's going on now, and Amazon's a great example of this, is that Amazon is offering Prime Now, which is their 1 to 2 hour delivery service in a lot of the major cities in the US. And the way that they're enabling that, from the research I've done, is that they're actually renting very small warehouses in unlikely areas that are very close to, on the fringe of some of the residential areas that they're really close to be able to deliver, right near entrances and exits to freeways, so they can get on and off the freeway to get to other areas very quickly. But in areas where there isn't that much of a mix of warehouses because you're not in the industrial parks. So if you were trying to capture Amazon's footprint going forward, it'd be very hard to actually forecast where they're going to have their demand. Right, because you're basically making a bet on a low demand area, and if Amazon isn't renting it from you, you might have a problem. So industrial, I'm a little bit weary of. I'm also weary of it in general because typically there isn't a highly diversified tenant base, and also it also tends to be quite susceptible to the downturn because you generally have like what they call like a vanilla box, or just a not too much of an improved property, just a shell that you're renting to somebody, and it's hard to differentiate that. And when you have an economic downturn and the economy slows, rents typically have a downturn. They tend to reduce very quickly within the industrial. And again, I'm making generalizations. Real estate is very location specific, so it all depends on the location and scenario. But I'm just making the generalizations when I'm giving you these perspectives.
Sure. I mean, we definitely appreciate the big picture stuff, and we appreciate you taking the risk of kind of making some of these general claims too, because I think it's really beneficial for a lot of investors. In terms of the class,
sorry,
yeah, go ahead.
Let me interrupt you. I'm sorry, Hunter. I will say that despite all this, I made an industrial investment in the last 12 months. I've actually made an office investment about a year and a half ago. I've made certain retail strip center investments with more of the mom and pop type of mix instead of big box retailers. So there's always opportunities out there, and there's always unique situations. I just want to be clear. I'm just giving you my high-level thoughts in general. So sorry to interrupt you on that. I just want to be clear about that too. It's not like I'm not looking at anything to do with any of those asset classes.
I'm really glad you made that clarification. I agree with a lot of the stuff you're saying, and I'm pursuing similar investments given the fact that I look for niche, weird investments that, are counter to, they're not publicly traded. So there can be these niche, weird investments that surpass some of those challenges you're presenting. Let's talk about classes of real estate. What classes, in terms of A, B, or C classes, what do you think are most susceptible for the next 5 or 10 years in terms of these trends, economic or otherwise?
Yeah, great question. So I tend to invest in Class B, and I'll tell you, I tend to stay away from Class A for two reasons. One is because those are more institutional type properties and they're being bid on by the hedge funds of the world who have a lot more money and are willing to take a lower return than I'm typically willing to take as a small individual investor. So the returns typically tend to be lower on a lot of the Class A, again, generalization, but a lot of the Class A properties. And so I stay away from them for that reason, but for another reason that often the Class A properties have kind of higher end tenants, right? Because they have to be able to afford the higher end rents. So when you picture a retailer who's going into a Class A property and they're selling, let's say, a higher end item, let's just call it Louis Vuitton, for example. And then it may not be the best example, but some high end tenant who may be susceptible to a downturn. If there's an economic downturn, they may be susceptible more so than, let's say, a dollar store, right? Or some other retailers like McDonald's. So I tend to stay away from properties in general that tend to be exposed to downturns as much as possible because I look for that stability because I live off the cash flow. So that's why Class A is just not typically something I look at. And I would say that as the trend of kind of low to flat growth continues, it's not clear that Class A will be as in demand as necessarily Class B or Class C. Again, that's a generalization, depends on the asset class. I personally tend to like Class B properties because I find that you can get the mix of tenants that still cater to kind of lower income families, where there tends to be more and more low income families occurring in the U.S. as the middle class is being eroded, unfortunately. But they also tend to be a little nicer, so they're not like you're not a slumlord. Tend to be in some better areas and locations, so for kind of future demand. Tend to be adjacent to certain, even some of the higher end suburbs in some cases. I like to go kind of mid-range. So I'm not going for the high end. I'm not going for the low end necessarily. Typically, I'm just going for the mid-range. And that mid-range tends to have the ability to do well in economic downturns as far as just having stable cash flow across many different asset classes. But if I had to make a bet on which asset classes are the safest going forward, if you think about having an economic downturn, clearly looking at Class B and Class C sound to be a little more safe than Class A. But again, it just depends on the scenario, and I know I'm generalizing.
Got it. Are there any markets that stick out that you're really concerned with? In obviously, each particular asset class has its own dangers in different markets, but from a big picture perspective, are there any markets that you think are just overheated or that you're, really not pursuing or selling on because of where we are in the cycle?
Yeah, I would say as a general rule, I think that most asset classes and most markets are overheated. I'm just going to say on the commercial real estate side. If you look at today's prices and cap rates, they just seem very, very high. So I'm concerned in general that we're kind of what I would say at the equivalent part of the cycle as the 2006 or 2007. So each time I make an investment now, I literally say to myself, okay, it's 2006 or 2007. Does this investment make sense right now? That's kind of the best way I'd characterize where I think we lie in my general concerns about the markets overall. I would say that there are definitely some residential markets that concern me more than others that have had some significant price run-ups in the past number of years relative to other markets. Great example is San Francisco. I don't think that's any surprise. If you take a look at the level of increases they've had recently, now they're already starting to kind of hit ahead. That's definitely one that seems like it's kind of overdone. There's been some other markets though that have had huge increases, like Portland, Seattle, and some others. And I haven't really been looking at single family much recently, so I'm not a good person to give you a really perfect perspective on it. But there's definitely a few single family markets in particular that have had very, very, very kind of outsized increases in their percentage increases in pricing. But as an overall measure, I would say I honestly consider most, if not all, commercial real estate asset classes to be overvalued on average. And so it's got to be a really unique deal or a unique scenario or unique pricing for it to make sense to me right now. And those do come up. It definitely, I like to tell everybody, even if you're in 2006 or 2007, there are still deals that make sense. You just have to be even more careful in terms of how you're buying them.
Definitely. So let's talk about some of the strategies we can utilize given this information. What are some of these strategies that you think investors should implement to help protect and grow their portfolio during these times?
First thing I would say is that be very careful right now. Again, I'm one person's opinion, but I tell everybody to be very, very cautious right now in terms of just going into an average deal. So if you want to protect yourself, just look for unique deals with unique pricing right now, where almost to the point where you say, okay, this is a no-brainer. And I'm going to give you an example, which will make sense, I think, to most people. So I invested in a several hundred unit apartment building in an area called Midland, Texas. And so for those of you who are not familiar with Midland is kind of the epicenter of oil. And that town is comprised almost exclusively of oil-related people in terms of their jobs. And so if you recall, oil prices have come down for the past couple of years. It was essentially like a 2009 moment for oil last year when there had been a couple of years of declines, significant declines from about $100 a barrel all the way down to the low of 26. And I think it was 26. And that resulted in some interesting scenarios from an investor perspective, because I was able to invest in an apartment building last year in Midland that literally had 2009 pricing. If you went back to 2009 and looked at the pricing per unit and looked at it today, we were in 2009 pricing territory. So you look at that scenario and say to yourself, look, if I can get 2009 pricing, even if we're in 2006 or 2007, that sounds okay. And even if oil prices go down again in that market, they'll eventually come back up. But if they go down again, we're going to end up back at 2009 pricing, and that means you bought it right, you'll have bought it right, and you'll be fine. So that's one really good example of something like it was a no-brainer. And I would advise everybody out there that if you're looking at an average deal across an average asset class right now and nothing looks too special about it, you might be getting in at a very high price, and to be very careful with it. You've got to get into scenarios where you're looking at a unique scenario that makes particular sense.
Yep, that makes total sense. Some other things to consider as well. Once you establish a deal that you're looking at, the underwriting criteria, the deal structure, the risk profile, also, and this may be the most important one, the experience. If you're investing passively, you want to make sure right now, especially, you're dealing with someone that has experience during different stages of the cycle. So when I look at deals, and I look at deals the way they're underwritten, if I look at a new deal and it's in a group that has been around since 2009, they may have stellar returns over the portfolio, and they should, because they start at the absolute bottom of the cycle. So, however, if you're dealing with a company that's been around for 30 years, they have seen many, many cycles. They know what to do in these cycles. If they didn't, they wouldn't still be around. So just looking at the experience, looking at that. And then if you're actually investing actively, invest in the things you are experienced in. If you're the person that you're depending on, make sure to make that call on something that you have done many, many times in the past, because I think that's really critical to kind of tighten up your strategy at this point. Okay, cool. So let's talk about, go ahead.
Sorry, Hunter, I just want to add in that, just to kind of further answer your question, it just occurred to me, I should say that, another thing you can do to protect yourself at this point is if you do believe there will be some type of economic downturn and some type of a price adjustment in the next few years, you're definitely going to want to invest in asset classes that do particularly well during downturns. And I'll just throw a couple out, like mobile home parks tend to do very well during economic downturns. Self-storage tends to do very well during economic downturns. Apartments tend to do very well during economic downturns. The only thing I would caution you of is that apartments are extremely expensive right now. Frankly, most of the asset classes are. So even though these are all good ideas for downturns, it doesn't mean that it just makes sense to go into any deal in any of these asset classes necessarily. You still have to find a particularly good deal right now from a pricing perspective because you want to buy it right. That being said, those are just examples of some asset classes that do well, particularly well in the downturn. It's another way to protect yourself if you're going to look at making new investments right now.
That's a really good point. Just to add to that, one of the keys for this is why it's not a good idea to just randomly buy something just because it has historically performed well during recessions, or the demand for the product increases during recessions like mobile home parks, is this X factor, which is the most important issue in all real estate investing, which is leverage, the loans, making sure that your leverage is conservative enough so that you can weather a change. So if, for example, if you look at the net cash flow, the net income of publicly traded mobile home park companies, they were basically stagnant or slightly increasing during the recession, which is great news if you're a cash flow investor. However, the valuation of those stocks was cut in half during those times because of fear from a liquidity standpoint. So be cautious of that, because if your loan comes due and the capital markets have changed so much so that now your property can only get 50% of the leverage that it could in the past, that's going to have a significant impact on the valuation of the property and could result in foreclosures if you're not careful with the amount of leverage you're taking on.
Yeah, great point, Hunter. Another thing too is that there are some projects I see that are maybe designed to maybe be new construction with temporary loans that refinance to the permanent loans in the next 1 to 3 years, or shorter term loans that are meant to refinance. And to your point with the lending market, you are taking an additional risk that at some point there may be a lack of liquidity to be able to refinance, like there was in 2008, 2009. So when I'm looking at opportunities today, I typically require at least a 7 and preferably a 10-year horizon on a fixed rate loan, for example, both to lock in interest rate, but also to be sure that I'm not going to get into a liquidity problem in the next 1 to 3 years if we end up in an economic downturn.
Totally. The longer the term of the loan, the more time you have to implement your value add strategy, stabilize the property, et cetera, just gives you more breathing room. Okay, let's talk about specific asset classes. And if it's okay with you, I'd like to just kind of do a lightning round, go through some of these asset classes. Give me your 2 to 5 minute explanation of where you think we are in this asset class, where the opportunity is, and how that kind of relates to the conversation we're having earlier about the big picture economic trends. Cool?
Yeah, sounds good.
All right, awesome. So let's start with senior housing. What are your thoughts on that asset class?
Well, I'm still learning about that, but I would say from what I've learned so far, senior housing is interesting. Definitely some overbuilding in certain areas. You got to be very careful with that. Most people are favoring development right now because more and more demand is coming into play. So development's probably the sweet spot there, even though I don't do that type of risk profile myself. And I would say the most interesting thing to consider is that I would have thought with my own bias about the population aging that senior housing would be a great fit immediately right now. But in fact, based on the age at which senior housing is typically used, and there's different categories of senior housing. There's assisted living, there's skilled nursing facilities, there's independent living. So you have to look at each subcategory. But I would say that until people are about 80 years old or older, there isn't necessarily a huge demand for senior living. So across most of those subcategories. So interestingly enough, the baby boomer population isn't expected to hit that sweet spot of average age up until about 2021. So I would say that overall, if you're going to look at senior living, just be very careful because you're not quite yet into the sweet spot across most of those subcategories. And so even though it sounds like it would make sense, just make sure you research that a lot to make sure that the specific subtype you're looking at is the right fit at the right time.
Awesome. Makes sense. What about self-storage?
Self-storage is real interesting. Self-storage, I love self-storage for many reasons. And the challenge with self-storage right now is it's on average is very expensive. Cap rates are very low. Prices are very high. And actually, I'm in 3 different self-storage deals right now that are under contract to be sold just to take advantage of the pricing at the moment in the markets. That being said, I love the fact that they do provide generally very good, stable cash flow during downturns that even in some cases end up from generating demand during downturns. So what I would say is self-storage is just be careful on the pricing. Typically, value-add opportunities are what makes sense right now because the pricing is so expensive. So buying stuff that's maybe owned by a mom and pop that's been mismanaged or not optimized is always a good idea. Make sure if you're going to look at an investment in self-storage, you're investing with sophisticated, experienced operators who are not mom and pop operators because it's a very complicated asset class to optimize revenues for. And I would say that it is definitely a good asset class on average to look at heading into a downturn. So you just have to make sure you're either buying it right or you have a good value add plan to be able to add enough value and give you enough padding should some of the valuations correct going into the downturn.
Yeah, brilliant explanation there. Multifamily apartments obviously been extremely hot, especially since 2013. What are your thoughts on that asset class overall?
Yeah, I would say that average stabilized multifamily deal right now at the current valuations, I completely stay away from. It was the hottest asset class and the first to get a run up after the downturn, and so it's been really, really bid up in terms of pricing. The deals that I see that people are trying to do these days are the typical value add, either kind of a rehab the units and increase rents, or some type of value add play because the pricing is so high to add more padding. And like I mentioned on the self storage side, kind of a similar situation. So I would say if I was going to look at something, which I'm not, but if I was going to look at an average apartment deal, that I would say to look at least at some type of value add component to help mitigate some adjustment in pricing. I really like apartments for downturns because they tend to be stable in the right markets as far as continued demand, and the rents tend to be somewhat sticky. So I think in the last downturn we had in 2009, I think the average apartment rent decrease in average price per square foot was only about 10%, which is really strong. And so it could be a really great asset class in a downturn for some pretty decent stability, especially from an occupancy perspective and a lack of price declines, relatively speaking. But just be really careful on that. Prices are very high. I cannot wait to jump back into apartments after we have some type of price correction. But I'm waiting that out overall, even though I did actually make 3 or 4 multifamily investments in the last 6 months, just based on those very unique situations I was mentioning before.
Interesting. What about office?
Office is real tricky to me for some of the reasons I outlined before, but in addition to the fact that with more people working from home, telecommuting technology making that more and more feasible, the demand for office going forward is really hard to predict. I also don't love office because there's a lot of tenant improvement costs associated with it, and if you haven't budgeted correctly for that, or if you have unexpected tenants leaving, then it can really put a dent into your cash flow. And since I look for stabilized cash flow, that tends to be very hard in terms of predictability. So I didn't, like I mentioned, I invested in an office deal about a year ago. It was unique pricing, and I couldn't resist it. I like the tenant mix for a downturn. But I would say office is tricky. So I'm actually not intending to look at that much office in the next decade. I'm sure a lot of people out there have different opinions. So I would just say be careful. Pricing is high in office like everything else. And if you're going to go into an office deal right now, be sure to look at the tenant mix and try your best to assess the probability of your tenants getting through a downturn. That's the number one thing to look at there aside from the pricing.
Cool. And you mentioned retail earlier, and you mentioned the enclosed malls, which are clearly basically a thing of the past. Big box retail obviously suffering, things like J.C. Penney, Blockbuster, even Sears, stuff like that really struggling. But what are your thoughts on the grocer anchored retail shopping centers?
Great question. So I have mixed feelings about it. I think in the short term, it's a great play. People are still going to have to go buy food when there's a downturn. So historically, I've always thought of that as recession resistant. But what seems to be a potential threat going forward in the next 5 to 10 years is a lot of people have been trying to do grocery online. It's very challenging with the very slim margins in grocery combined with delivery costs. It's very hard to do. Amazon is looking at some store concepts right now in grocery where they would have a much smaller retail footprint. So maybe say half the size of a regular grocery store, and either curate items or not require cashiers for automated checkouts and all these things that would allow them to do a smaller footprint. So I am concerned about investing in a grocery deal from a 5 or 10 year horizon perspective at this point, because I'm afraid that a lot of these large grocery chains, they may very well survive, but I think they're going to survive in a smaller footprint. And so if you have, a large store right now that you have as your single tenant, your single largest tenant, you're dependent on that rent, and then they renegotiate half the footprint, that's a pretty major change in the rent. So I am being very careful, and I consider that kind of the big box. It's not just a grocery problem. I think it's a big box retail problem that could come up in the next 5 to 10 years that I mentioned before, where I'm concerned that some of these retailers are going to scale down. That all being said, I want to throw out an interesting statistics that I saw recently, which is that so far in the U.S., 86% of sales still occur in brick and mortar stores. Only 14% of all retail sales are online, which actually surprised me. And I think I'm a little biased because I live in a larger city where maybe there's a higher percentage of the population use online versus some of the outlying areas. But still, 86% of retail sales still occur in brick and mortar shops. And so they're clearly not going away completely anytime soon. But, we're talking about 5 to 10 years from now. A lot can change in 5 to 10 years.
Yeah, that's a good point. Speaking of a lot can change in 5 to 10 years, hotels. You mentioned recently they haven't really recovered. I think Airbnb has certainly played a role in that. And also, one of the first things that businesses tighten up when they have corrections is travel. So I think a lot more conferences and meetings are taking place via Skype, on the internet, et cetera. What are your thoughts on hotels going forward?
Yeah, great question. Now, I tend to stay away from hotels for the most part just because of the average daily rate volatility. So I'm not the best person to give you an opinion about a hotel. I would say on average, I'm definitely concerned about the adjustment factor in terms of average daily rate going into a potential downturn, like you mentioned. Um, and It's interesting though, because hotels are very location specific, like anything else, right? So if you were looking at investing in a hotel that was half a block away from Disneyland in California, as an example, all you'd want to look at for the most part is what is the demand going to be at Disneyland for the next 10 years, and if you believe it's going to be strong, then you don't care about the business travel. I'm just saying. So there are definitely unique situations and exceptions to the rule when it comes to hotels because they're all very location specific. But I tend to stay away from them in general because of that volatility. So it's hard for me. I don't know the asset class as well. It's hard for me to give you a good 5 to 10 year horizon on them.
Okay, fair enough. What about mobile home parks? We haven't really talked much on that yet, but I have a feeling you have an interesting perspective on that one.
Yeah, mobile home parks are real interesting. I love them for many reasons. Most because of the stability of the income and the very low turnover rates. I'm a little concerned about them now because they're becoming a little bit what I would call hot, meaning that they were one of the last asset classes that had price increases because people had been chasing yield across apartments and other asset classes, and they finally turned around to mobile home parks. There's still a lot of yield left in them about 24 months ago. And so prices have come down for the last 24 months in that asset class. Sorry, prices have gone up. Cap rates have come down for the last 24 months in that asset class. And I think cap rates have gotten quite compressed, and I'm definitely concerned about valuation. That being said, I do think that if you're able to buy something at say better than average price and you have a value add strategy, there's still a lot of opportunity out there on the value add side. Mobile home parks are synonymous with mom and pop ownership. And what that means is that they tend to be either mismanaged or not optimized. And that's very, very common in mobile home parks, probably more so than any other asset class I could think of. It happens a lot in self-storage too, but mobile home parks are just probably the most renowned for that. So I would say that from a value add implementation perspective in terms of a strategy, it's probably one of the most obvious ones to implement. So not only do you have an asset class that does well in the downturn, but you have an asset class where the implementation of value add strategy tends to be more obvious than a lot of other asset classes. So if you buy right, you've got the value add strategy there that looks like very high probability to succeed, then you're well positioned going into a recession on it. My only concern is really valuation, right? If you're looking at a mobile home park that's in the 7-something cap range or doesn't have too much value add potential and it's stabilized, I'd be concerned because I do think that mobile home parks will have a pricing correction at some point based on current cap rates versus historical. So a lot to like there, and just be careful how you're buying it.
Totally. And again, not to harp on the same point, but particularly with these niche, weird investments, it all comes down to leverage. So when things tighten up, the first asset classes to struggle to get financing are the ones that the banks are less familiar with, and mobile home parks would be certainly one of them. I love the asset class too. Just be careful about the leverage you're looking at. So I know that your expertise is generally in real estate, but I also want to get your perspective on oil as the last asset class. What are your thoughts on oil in terms of the previous opportunity there because of the collapse in prices? And what do you think for the next 5 to 10 years there?
Great question. Boy, is oil hard to predict. There's so many factors, a lot of which are political, and frankly, I think a lot of price manipulation, but that's just my own opinion. I have no basis in fact for that. But so with oil, what's been going on in the past couple of years is that prices have come down. There's been a surplus of oil essentially throughout the world, and OPEC came together, tried to cap their oil production to limit the surplus, and they're still working through those surplus inventories. Oil is actually, as we speak, coming down the past week just because people are seeing that the surplus is still there, and there's a lot of increased production coming through the U.S. shale production that OPEC is trying to offset, but they're kind of almost, I wouldn't say cancel each other out perfectly, that's not true, but the U.S. increase in production is actually having a very negative effect on the price of oil. And so That one is very hard to predict on a 5 to 10 year timeline. Here's what I would say. First thing is, we had a downturn a couple of years ago. We went down to about $26 a barrel. I got lucky. I invested in 3 really good short sales of working well properties that we got at fantastic prices. Just to give you an idea, the current market value of those properties is probably at least twice what we paid for them even a year ago, just because we bought them at the right time, right? It was like 2009 for oil last year. So my concern at the moment is that I am anticipating that with an economic slowdown, we would have one more price adjustment in oil before it maybe goes back up. So I'm waiting to see if and when we have a downturn to see what happens to the price of oil. And if it does go down further, as I'm hoping or expecting, then I'm hoping to jump into a few more projects at that time just to get them at the right price. And then from there, I think we'll probably be stabilized back up to 40, 50, 60 or more dollar range. So I think in the short term, there's a lot of downside potential, both because of increased shale production in the U.S. Combined with a potential economic downturn. So I'd be very careful in the short term. But in the medium to long term, I think that if you can get in at the lower prices, saying somewhere between the 26 and 35 to $40 range, then I think you're positioning yourself really well. Of course, that's speculation. Oil can go up and go down many different ways. The one thing that a lot of people don't talk about with oil is that there's certainly a certain break-even price of oil in terms of production cost, and that occurs throughout. It's different throughout different areas in different countries. And like any other good or service, there's a point at which people won't produce it if they're not going to get enough money to actually break even on the production. So I believe oil has an artificial low point. I would say not artificial, but actual cost of goods low point of probably in the 20 to 25 range. Nobody knows for sure exactly what it is. So if you can get in at 25 to 30, you're getting in almost to the point where probably a lot of people would stop producing, and then the whole supply demand will level out, right? Which will automatically bring the price up because supply will reduce. So I think if you can get something in the 25 to 30 range, you're really golden, which is why I jumped on that last year. But I do think we have some downside risk in the short term, and to maybe wait for that potentially.
Awesome. That's perfect. So last question, where do you think the big opportunity is going forward? And let's just keep it to this 5 to 10 year horizon.
Yeah, great question. I wouldn't summarize it as the big opportunity, quote unquote, because it's funny. I don't invest for the big opportunity. I invest for like good deals with stabilized cash flow where I don't have to worry about, where I have like downside protection because I bought at the right time or some type of value add potential. What seems most obvious to me in the next 5 to 10 years are the following asset classes. Senior living, contingent upon investing on the right subtype category at the right time based on the population demand in the area. Mobile home parks, because I believe that household incomes are going to continue to be flat or low growth. I think there's going to be a lot of affordable housing demand. And without getting into too much specifics, supply of mobile home parks actually goes down every year. And demand theoretically probably increases as the population gets bigger. So that's a great supply-demand story going forward. Self-storage, because it does very well in a downturn typically. That doesn't mean that you should go jump into a self-storage deal today on average because the pricing is very high. But the right deal in the right market going forward, and a great example of two great markets to look at in the next 10 years, by the way, for self-storage, most likely Texas and Florida. And again, I'm generalizing. Some areas of these states won't be as good as others, but those are the two states that are forecast to have the highest population growth in the next 10 years. So population moving in, gonna need to store some stuff. Maybe they can't quite put into the new home they're moving into, or maybe people are moving around in those areas. So I could see increased demand for those that asset class in those areas specifically. But in general, I really like the economics of especially in the right locations for that asset class. And apartments. I haven't invested in apartments as a generalization probably since 2013 when I thought apartment prices were getting expensive. But I cannot wait to jump back into them because I do think apartments are going to continue to be in high demand as they're more affordable alternatives to houses. When you think about household incomes being flat or not increasing that much, I think apartments are going to have continued demand. There's been a lack of new construction and supply come online in many markets in general in housing, both in apartments and single family. And so I think that apartments are really, really positioned to do well in the next 10 years. That being said, I just won't go near, not even with a 10-foot pool, an average apartment right now until we have a correction in pricing, because I just think we're way overvalued on a lot of apartment buildings right now.
Awesome. Well, Jeremy, I really appreciate your perspective. Definitely a lot to digest. I know some people are going to listen to this one more than once for sure to get all that information. So thank you so much for coming on. I really appreciate it.
Yeah, thanks very much for having me. Hopefully this was helpful. I know we covered a lot of ground. Hopefully it wasn't too much.
No, I think it was really, really useful. For all the listeners out there, wow, I really hope you enjoyed this episode. Doesn't get much better than that. Jeremy is a really intelligent guy with a lot of important perspectives on these really important topics. So if you want to contact Jeremy directly, feel free to do so. You can email him at jroll@rollinvestments.com. That's jroll@rollinvestments.com. Also, don't forget to subscribe in iTunes in the podcast app. That way you get our new episodes downloaded directly to your iPhone, and we would really appreciate it if you would leave us a positive review. Thanks a lot.